Hello, I'm Peter Herbert. Welcome to the latest in our series of short CPD webinars covering topical issues of financial reporting and auditing. In the 18 months or so we've been doing these sessions, one topic we've not covered, but one that we get lots of questions on, is small company and small group limits. And that's what we're going to cover off today. This is a topic which impacts on the financial reporting regime that you can apply in the UK. It also impacts significantly on the need for audit. As I said, we get lots of questions on it. It is an area that I think also people do get wrong, and that's why I think a good topic for coverage here on the session today. So what we're going to do, we're going to start off by looking at the small company rules. We're then going to look at the small group rules and finish off by looking at one or two aspects in relation to charities where the rules are slightly different. Okay, let's begin then with the small company rules. On this slide, we've got limits for micro, small, and medium. If you're below 2 out of 3 of the relevant thresholds, then you qualify. So micro, 632,000 turnover, 316,000 assets, 10 employees. If you're below 2 out of 3 of those, you qualify for FRS 105. If you're below 2 out of 3 of 10.2 million turnover, 5.1 million assets, and 50 employees, then you are small. You're eligible from a financial reporting point of view to apply Section 1A of FRS 102. And of course, very importantly, you can avail yourself of audit exemption. The medium-sized company limits, so 36 million turnover, 18 million assets, and 250 employees. Yeah, that I think probably is less impactful, the difference between a medium and a large company. I guess there are some disclosure requirements that would apply to large companies that do not apply to mediums, but there are not many of those. And I think more of the questions we get are around the boundaries between micro and small, and between small and medium. Let's look at an example. This is looking at the boundary between small and medium. So A Limited incorporates on 1 October 17, results for its 4 periods ending on 31st of March 18, 19, 20, and 21 are given. And the question here is, A Limited eligible to apply the small company accounting exemptions and able to avail itself of audit exemption for 31st of March 21. Let's work through the years individually. The trick with this example is to realize that in the first period, we've got a short 6-month accounting period ending 31st of March 18. And therefore in that first period, we have to prorate the turnover threshold. So in terms of the small company limits, 10.2 million divided by 2 is 5.1 million as our turnover threshold, 5.1 million as our balance sheet threshold, and 50 employees. And yes, in that first period, we are breaching on the prorated turnover limit and the balance sheet total limit. And therefore, in that first period, we are medium-sized and we apply full FRS 102. Same thing applies in our second full accounting period ending 31st of March 2019. So 10.2, 5.150. Again, we breach on the turnover and the balance sheet. So again, in that second period, we are going to be medium, and it's therefore full FRS 102 and audit. In the third accounting period, we would say, again, 10.2, 5.150. Again, we're breaching on 2 out of 3 of the limits. This time it's the balance sheet total and the employee numbers. And again, in that third period, therefore, we qualify as medium. And in the fourth period, we have obviously now got figures that have dipped down. We're now below on the turnover, below on the balance sheet total, and below on the employee numbers. But this, of course, is the place at which the 2-year rule kicks in. And the 2-year rule says that if you are basically in the place whereby you dip below 2 out of 3 for the first time, you've got to carry on doing the more onerous regime for 1 further year in case it was a fluke. So yes, by virtue of the 2-year rule here, we are still for 31st of March 21, medium-sized. We are therefore applying full FRS 102, and we do need to do an audit. The way I've always thought about the way the 2-year rule works, if you're looking to apply the most simplistic regime, the 2-year rule works in your favor on the way up, and the 2-year rule works against you on the way down. And here we see this happening because we're shrinking, we're below 2 out of 3, but 1 further year of full 102, 1 further year of audits before we can avail ourselves of the more simplistic 1A regime and therefore audit exemption. Okay, now that would be the same for a FRS 105 scenario, obviously based on the lower FRS 105 or microentity limits. Those €2 works in the same way as well. I guess the other thing I would just say in terms of balance sheet total, to remind you that of course is gross, not net assets. The total of fixed and current, not net assets, to determine your balance sheet total for the purpose of doing the test there in relation to the limits. Okay, the other thing to mention in relation to the small company regime, it's not a regime you can apply if you are an ineligible company. And this slide summarizes what we mean by ineligible company. I suppose a couple of points to flag. Yeah, we do get quite a few people asking us about situations where maybe they are looking at a company which has lent money. Yes, to work out whether you are ineligible from applying the small company regime because you lend money, you may need to do a bit of a deeper dig to ascertain whether you're indeed a banking company or a MiFID investment firm. Just because you lend does not automatically mean that you're in the ineligible category, but that can sometimes need to be looked at quite carefully. We'll talk in a few moments when we move on to the group situation about what we mean by a member of an ineligible group, because if you're a member of an ineligible group, you'd not be allowed to apply the small company regime either. And then public company, yeah, that is one we do come across reasonably regularly. Remember that we're not talking necessarily there about a traded public company, but any company which is a PLC. And yes, if you're a PLC, you cannot apply the small company regime. You cannot apply the medium-sized company regime. You've got to apply full FRS as it would apply to large companies. And one thing we found that's caught a few people out in the last couple of years around that is if you're a public company, you'll need to incorporate in your narrative report a section 172 statement. Very odd if you're a very small sized public company, but yes, by virtue of not being eligible for the small company or medium sized company regime, that will be the consequence if you are a PLC traded or otherwise. Okay, so that's a few thoughts on small companies. Let's now move on and think about small groups. Now here are the group limits. We again have got our small group limits. We've got our medium-sized group limits. Again, I think the distinction between a medium-sized and large group is not of any great consequence day to day for many. But I think the important consideration here is more around is a group small? If a group is small, there is no requirement for consolidated accounts. If a group is not small, you do need consolidated accounts. And very importantly, from an audit point of view, in a medium-sized group, any non-dormant subsidiary would automatically need an audit wherever the group is effectively domiciled. Any non-dormant UK subsidiary in a medium-sized or large group automatically does need to have an audit. So again, as I mentioned in the preamble, important implications here from a financial reporting point of view, but really important implications as well from an audit perspective as well. We'll move on shortly and think about some of the considerations specifically in relation to audit. Remember that in terms of the small group limits, we've got effectively two sort of types of thresholds to play with. We've got the gross, so gross of consolidation eliminations, and net of consolidation eliminations. And we've got such limits for turnover, for balance sheet total or gross assets. Obviously, employee numbers, we don't have a gross and net threshold. That is 50 in the same way that it is for the small company limits. Okay, that gives us a summary then of the limits. Let's then have a look at an example for, again, a scenario, group scenario. Now, what we're going to do with this example is just drill down, initially at least, on the gross limit. So gross or before consolidation eliminations. Okay, we're going to look at that aspect in terms of turnover, in terms of assets, fixed and current, and in terms of employee numbers. And again, in terms of those gross thresholds, we're therefore looking at 12.2, 6.1, and 50. Okay, so we've got a newly formed group. First year, full year, year end 31st of March 20. And in that first year, we're saying the group would actually be small because we're below in that first year on all three of those limits: 12.2 turnover, 6.1 assets, and 50 employees. So in that first period, small group, no consolidated accounts required. Year two, again, 12.2, 6.150. We're saying in that second year, we are now basically breaching on the turnover. We're breaching on their employee numbers, and therefore we initially look as if we are now moving towards being a medium-sized, but not a small group. But no, again, by virtue of the 2-year rule, we can actually carry on being small for 1 further year, and that will therefore mean for 1 further year, no consolidated accounts are required. In the first example, looking at the small company limits, we had a contracting, shrinking company. Here we've got a growing group. And again, the dispensation of no consolidation works really well by virtue of that 2-year rule for year end 31st of March 21. Now, again, looking at those limits of 12.2, 6.150, in year 3, we now look like we're going to be medium. We are going to need consolidated accounts. And again, going back to my earlier point, in a medium-sized group, any non-dormant UK sub would automatically need to have an audit as well. So impactful from an audit point of view there, as well as being impactful from the need from a consolidation accounts point of view as well. That being said, the way I always think about the way that these limits work is you can kind of mix and match net and gross to get you where you need to be. So in relation to our turnover limit there, 12.6 gross turnover before consolidation eliminations exceeds the 12.2 million limit. But if we basically eliminate our intergroup turnover and we get to a place whereby our net group turnover after the consolidation eliminations is below 10.2 million, then we will still be small. And yeah, you can mix and match net and gross to where you need to be. So if you blow on the net turnover limits and below on the gross assets limits, that's fine. Any mix and match will do. But yes, without information about the amount of intercompany sales here, to actually do that calculation, that would be a medium-sized group, consolidated accounts required, and as I say, implications there for audit as well. Now, I guess if you are in that medium-sized group situation, the most common ways to avoid audits for the individual subs would be, can we convince ourselves that an individual subsidiary within that medium-sized group is dormant? I think the law defines dormant as no significant transactions in the financial year, and that would be transactions that should be included in individual accounting records. So very little in terms of activity there in order to qualify as dormant. The other way which you can, of course, get audit exemption in the situation that you do have a medium-sized group is to take advantage of the Section 479A guarantee. It's been around, hasn't it, for sort of 5 or 6 years now, this. And what we say here is that when a parent company in that medium-sized group provides an unequivocal guarantee over all the year-end liabilities of an individual sub, that sub in its own right would not need a separate statutory audit. Okay, that would be audited as part of the bigger whole, but you'd not need to have a separate statutory audit. Now, that Section 479A guarantee has been around for quite a few years now. I don't find it's massively regularly used, but it is something to think about. I guess for lots of people that have got groups where you maybe segment and compartmentalize different activities in different trading subsidiaries, maybe to take advantage of the limitation of liability, why would you want to then sort of kind of blow that away by providing an unequivocal guarantee over all the subsidiaries' individual year-end liabilities, the year-end debts? Probably not for many, but it is used, it is there, and that's the other way you can avoid audit for the individual sub, where you would ordinarily need the audit by virtue of that being a subsidiary in a medium-sized group, and the audit therefore being required based on company law. Now, there's a summary of the key criteria for using that Section 479A exemption. I put a link on the side to a very useful Institute help sheet that gives you lots of information about the way that parent guarantee works. It's quite a detailed area in terms of protocol and procedure, but all the details in that help sheet. Do click on that link if that would be useful. The other thing I'm supposed to mention in relation to the way the Section 479A guarantee works is we've now got a situation whereby prior to accounting periods beginning on or after 1 Jan 21, the guaranteeing parent would need to be registered in an EEA member state, including the UK. Because of Brexit, the guaranteeing parent would now need to be registered within the UK. So a French, German, Spanish parent providing the guarantee would no longer work for periods commencing on or after 1 Jan 21. So that might mean that where guarantees worked before, because of Brexit, they no longer will. Okay, we talked, didn't we, about the definition of an eligible company. Here's the definition of an ineligible group. And a group is ineligible if any of its members is as defined on this slide. So yes, what we're saying there essentially is that where you have got a group that's small based on the numbers, you would still need consolidated accounts if any of the members in that group was on this list. Also, I would say that any entity within an ineligible group would in its own right automatically be not eligible to apply the small company regime and therefore Section 1A of FRS 102. The one we get probably most questions on tends to be the top one. So UK traded company. Yeah, these are basically listed companies. I guess a couple of points to make in relation to the UK listed companies that will basically be making a group ineligible is that would be London Stock Exchange listed, not AIM listed. So although AIM listed companies are listed, they are not formally what we would call traded. And again, small tweak there off the back of Brexit. That first point used to refer to a company whose shares are traded within an EEA member state. That is no longer the case. They now have to be traded within the UK. So the way it would have worked pre-accounting periods beginning on or after 1 Jan 21, where you had a UK sub of a German listed parent, you would not be able to apply Section 1A in that entity in the UK. You now would, although of course that individual sub would still need to be audited. It would be able to avail itself of the Section 1A regime because it does not meet the definition of any of the points on this slide, and therefore it would be in scope for Section 1A. A couple of final questions on small groups. We get this one quite a lot. P Limited does not breach the small company limits, but is the parent in a medium-sized group. Can it apply Section 1A of FRS 102 at its own account? The answer to that one, of course, is no. If you're the parent company in a medium-sized group, you must consider yourself to be medium-sized as well from a financial reporting point of view. Okay, so FRS 102 full for the parent company in a medium-sized group, even if the figures in that individual company's accounts would suggest it's small in size. Does not work the same way for the second scenario. Okay, so P Limited does not breach the micro company limits, but is the parent in a small group. So if you're the parent company in a small group and you're micro sized, you can absolutely apply FRS 105 for the purpose of preparing your own financial statements. If you're a micro-sized parent in a medium-sized group, again, you can't. But if you're micro-sized parent in a small group, then 105 will work for your own accounts. That again is quite helpful, I think, because it just shows difference there between the way the rules work in small groups and medium-sized groups in terms of what parents can do in relation to the regime for their own separate financial statements. Okay, let's finish off with one or two points about charities. I guess the key thing to bear in mind in charity world is that the limit we all focus in on in relation to consolidated accounts, and for that matter in relation to audit exemption, is 1 million income. And that's the headline figure, isn't it? And certainly in terms of the audit threshold and the threshold for consolidated accounts, certainly in England and Wales. One or 2 points to be aware of on the edges there, which make this a slightly different regime to what we have in relation to ordinary trading companies. First of all, remember that we do also have that secondary threshold. Don't cover that often on courses, but it's one we also always need to be aware of. In the charity world, we've got a charity with income of more than 250k, which therefore looks for all the world like it would be audit exempt, but it's got a balance sheet total that exceeds 3.26 million, then that would still need to have consolidated accounts if it were a group, and if it was a standalone charity, would need to have an audit. No 2-year-old, so the 2-year-old we talked about all the way through this short session does not apply in any way, shape or form to charities in the way it does to ordinary trading companies. It's much more simple and based on that headline figure. Do be careful about one-offs. Charities can get things like one-off sources of grant income being pushed through the SOFA, pushed through the P&L, which might for an individual year push you above the limit. You can apply to the Charity Commission for a dispensation from having an audit done. but you probably will get short shrift when you do make that application, certainly if it's in relation to grant income. And that, I guess, reinforces the point that we don't have that 2-year rule here in the same way that we do for ordinary trading companies. The limits north of the border are different. The audit limit north of the border and the limit for consolidated accounts north of the border is 500,000, where in England and Wales it's 1 million. So again, if you are acting for charities across the border, then do remember the rules differ in those different jurisdictions. We saw in that very first example, then we're looking at the small company limits, that we do prorate turnover in years where we've got a shorter or longer accounting period. That does not apply at all in this particular area. So if you've got a charity with a short accounting period or a long accounting period, then that 1 million income threshold applies in the same way, whatever the length of the accounting period. Again, quite an easy trap to fall into as well. And do look very carefully about what is and isn't in the 1 million limit or the 250k limit. I mean, lots of things are. I got a question the other week on a situation where a charity made a very big profit on disposal of a fixed asset. Is that in the 1 million? Well, I think that is very much in the 1 million. What's not in the 1 million would be, for example, a revaluation gain on the revaluation of an investment or a revaluation of an investment property that might have washed through the SOFA, might have washed through the P&L. So look carefully there. But outside things like revaluation gains, much stuff counts towards the 1 million, and therefore you can often need an audit or need consolidated accounts when you might think, well, the nature of that gain might not require it. Do look very carefully, because very often it will. Okay, so I hope that was useful. That's just a quick run through some points on small company limits, small group limits, and the very different rules that apply in the context of charities. If you've got any questions or queries about the content of this short session, do drop us an email, inquiries@insight-training.co.uk. For our full autumn programme, check out our website, www.insight-training.co.uk. And do remember, you can get access to all our sort of catalogue of previous CPD recordings from the blog and news section of our website. So do have a look at that if that would be useful. Hope that was helpful. Good to speak to you all. Speak to you all soon. Goodbye.